Imagine uncovering hidden pockets of savings you didn't even know existed. What if you could keep more of your hard-earned money just by understanding a few key tax strategies? Today, we're cutting through the complexity. We want to give you a shortcut to some powerful, actionable tax-saving knowledge. We're about to do a deep dive into Schedule A itemized deductions. And look, this isn't just about forms, right?
Not at all.
It's about finding the specific ways you could potentially lower your taxable income for 2024. Our guide for this whole thing is the official Instructions for Schedule A, Form 1040, Itemized Deductions. And it's dense, it's packed with detail.
Definitely is.
So our mission today is to pull out the most important nuggets, the key insights for you, things that could help you find, real tax savings, savings that could directly impact your wallet.
That's right. And whether you're already thinking about next tax season, maybe prepping for a meeting with a financial advisor, or, just curious about optimizing your financial health, understanding these itemized deductions is, well, it's crucial. We'll flag the actionable stuff, try to shed some light on the tricky parts of the tax code so you can make smarter choices.
Okay, so we're aiming to cut through that complexity. But before we really dive into the weeds, let's maybe set the stage a bit. When you sit down to do your taxes, there's this basic choice you have to make, isn't there? A kind of fork in the road for reducing your taxable income. This is where that standard deduction versus itemizing comes in. Making the right call there seems like step one.
Absolutely. It's fundamental. The core idea is, well, pretty simple, really. You want to choose whichever deduction is larger. That's how you minimize your federal income tax. The standard deduction, that's a fixed amount. It depends on your filing status, single, married, whatever. It's straightforward. Kind of a set it and forget it deal for many people.
Easy.
But itemizing, which is what we're digging into today, lets you list out specific eligible expenses you actually paid during the year. So the crucial first step, before you even think about which choice to make, is knowing what you can actually itemize, and maybe more importantly, what the strategic thinking is behind those deductions.
Okay, so it sounds like it's really about tailoring your deductions to your actual spending, your specific situation. What are the big categories, the main buckets of expenses we're looking at when we talk about itemizing?
Generally, when you itemize, you're looking at 5 main areas. First, medical and dental expenses you paid. Second, certain state and local taxes. Third, interest you paid, especially home mortgage interest. Fourth, contributions to qualified charities. And fifth, in some very specific cases, casualty and theft losses. Those are the main lanes Schedule A covers.
It makes sense that, getting this specific also means there are strict rules. Potential pitfalls. What's the absolute biggest caution sign, the main exclusion people really need to watch out for?
Yeah, you've hit on a really key point there. The IRS is crystal clear on this one. No double dipping.
Right.
The instructions literally say, don't include on Schedule A items deducted elsewhere. Like on your main form 1040, or maybe Schedule C, E, or F for business or rental income.
Okay.
This rule is critical. So if you've already claimed, say, a medical expense as a business expense on your Schedule C, and maybe you're a freelancer, you absolutely cannot claim it again here on Schedule A as an itemized deduction.
Gotcha.
It sounds obvious, but it's a common mistake. Can lead to problems. So you always need to look at the whole picture of your tax return first. If an expense might fit into a business category or somewhere else specific.
Check there first.
Exactly.
Yeah.
Check those forms first before you even think about putting it on Schedule A. It's just fundamental for being accurate.
That's a crucial starting point. One deduction, one place on the return. Okay, now let's get into the specifics. Let's start with medical and dental expenses. This feels like an area where, lots of people have significant costs, but it also feels like there's a lot of nuance. What's the first big hurdle we need to understand?
The main hurdle, and it's a big one, is the adjusted gross income threshold, the AGI threshold.
Right, the percentage thing.
Exactly. You can only deduct the part of your medical and dental expenses that goes above 7.5% of your AGI. And that AGI number comes from line 11 of your form 1040 or 1040 SR.
That's 7.5%. That's a pretty high bar for most people, isn't it? The real takeaway here seems to be, unless you had a really tough year health-wise, or maybe have a chronic expensive condition, these deductions often just won't make a difference for the average person. It really changes who can actually benefit. Makes it much less universal than people might think.
It really does. So like you said, if your AGI is, say, $100,000, you need to have more than $7,500 in qualifying medical expenses before even the first dollar becomes deductible. Only the amount over $7,500 counts.
Wow. Okay.
So that naturally leads to the next big question. what expenses actually count towards hitting that $7,500 number in our example? And maybe just as important, whose expenses can you include? Is it just you, your spouse? Or can you maybe count costs for other family members too?
When I think medical costs, my mind usually jumps straight to, like, doctor visits for me or my family. But you mentioned it could be broader. What are some of the maybe less obvious things or surprising things that actually fall under this medical expense umbrella?
Yeah, this is definitely more expensive than a lot of people realize, which, can open up some good opportunities for tax savings if you qualify. So you can include medical and dental bills you paid for yourself, obviously, for your spouse, and for all the dependents you claim on your tax return.
Okay, that makes sense.
But it actually goes a bit further than that. You can also include expenses for your child, even if you don't claim that child as a dependent because of those specific rules for, like, divorced or separated parents.
Well, that's interesting. So even if they're not technically your dependent for, say, the child tax credit, the medical bills you paid for them could still count towards your medical deduction total.
Absolutely. That's a really important distinction, yeah. And it also applies to any person you could have claimed as a dependent, except that person maybe earned too much money. The threshold was $5,050 in gross income for 2024, or they filed a joint return.
So like an elderly parent you support.
Exactly. Perfect example. Let's say you provided more than half of your parents' support, but you can't claim them as a dependent because they earned, I don't know, $5,100 in wages in 2024.
Right, just over the limit.
Yep. You can still include any medical or dental expenses you paid for that parent towards your own potential deduction. And the same logic applies if you or your spouse, if you're filing jointly, could actually be claimed as a dependent on someone else's tax return for 2024. So it really does broaden the scope. It can be a significant help for people supporting extended family members with healthcare costs.
That's fantastic to know. Okay, now for the big list. What specific payments can you actually include in your medical and dental expense total? Assuming, of course, you weren't reimbursed by insurance or something. This feels like where we find those hidden pockets of savings.
Right. This is the crucial part, and the list is pretty extensive. So let's run through some key ones. First, insurance premiums for medical care, dental care, and that includes premiums for qualified long-term care insurance contracts. But remember, always reduce these premiums by any deduction you might have taken elsewhere, like the self-employed health insurance deduction. And importantly, you can't include premiums that were paid by your employer through a pre-tax plan, like a cafeteria plan, where the money wasn't included in your income in the first place. That's already tax advantaged.
Right. No double benefit.
Exactly. Same goes for premiums paid with tax-free distributions from retirement plans if you happen to be a retired public safety officer. That's a specific rule.
What about those long-term care premiums? You mentioned those. Any catches there?
Yeah, for qualified long-term care insurance premiums, there are specific limits based on the age of the person covered. These limits change, so you have to check the year's rules.
Yeah.
For 2024, for instance, if the person was 40 or under at the end of the year, the most premium you could count was $470.
Right.
That limit goes up with age. Someone over 70, for example, the limit was $5,880 for 2024. So it's definitely age dependent, a detail worth noting if it applies to you.
Got it. What else makes the list beyond the insurance premiums?
Think broadly about the professionals. Payments to pretty much any licensed medical professional. Your regular doctor, sure, but also specialists like chiropractors, acupuncturists, dentists, eye doctors, occupational therapists, osteopaths, physical therapists, podiatrists, even mental health professionals like psychiatrists, psychoanalysts, and psychologists, as long as it's for actual medical care.
So a wide range of practitioners.
Definitely. And of course, prescription medicines or insulin are included. That's a common one. Also, things like medical exams, x-rays, lab services, insulin treatments your doctor ordered, those all count.
So it's not just the visit, but the tests and treatments tied to diagnosis and care.
Exactly. Diagnostic tests, think full body scans, pregnancy tests, blood sugar test kits, those are in. Nursing help is another one. You can deduct payments for nursing help, including your share of employment taxes you might have paid for that help.
Okay.
But there's a catch. If the person does both nursing and general housework, you can only deduct the cost for the nursing part. You have to allocate.
Oh, okay. Makes sense.
Hospital care, obviously. That includes meals and lodging while you're in the hospital. Clinic costs, lab fees, those are generally deductible. And qualified long-term care services themselves, not just the insurance premiums. You look at publication 502 for the details on what qualifies there.
What about Medicare premiums? Lots of people pay those.
Good question. Yes. Medicare Part B premiums, the supplemental insurance, and Medicare Part D prescription drug premiums are deductible. And if you're 65 or older but not automatically entitled to Social Security benefits, you can even deduct premiums you voluntarily paid for Medicare Part A coverage.
Interesting. Okay. What about some maybe less common health expenses? Things focused on prevention or specific conditions.
Sure. A program to help you stop smoking is deductible, and prescription medicines specifically to help with nicotine withdrawal also count.
Okay.
Weight loss programs can qualify, but only if they're a treatment for a specific disease diagnosed by a doctor. And that includes obesity, which the IRS now recognizes as a disease for this purpose.
That's a key distinction doctor diagnosed.
Very key. Medical treatment at a center for drug or alcohol addiction is also deductible. Then you have all the medical aids. Eyeglasses, contact lenses, hearing aids, braces, crutches, wheelchairs, even guide dogs for the visually impaired or hearing impaired, including the costs to maintain the dog, like food and vet bills.
Wow, even the dog's upkeep.
Yep. Surgery to improve vision, like laser eye surgery or radial keratotomy, is also included.
And what about travel? Getting to the doctor or hospital can be expensive, especially for specialized care far from home.
Right. Travel costs primarily for and essential to medical care are deductible. This includes lodging, but not meals, while you're away from home to receive medical care from a physician in a hospital or a related facility. There are a couple of conditions, though. The care has to be in a licensed hospital or equivalent, and there can't be any significant element of personal pleasure, recreation, or vacation in the travel.
So no deducting a trip to Florida just because you saw a doctor there for an hour.
Exactly, and there's a limit on the lodging. No more than $50 per night for each person who meets the requirements that could be the patient and potentially a caregiver if necessary. Ambulance service costs are deductible. And for other travel, like driving your own car to appointments, you can deduct your actual out-of-pocket expenses for gas and oil, or you can use the standard medical mileage rate. For 2024, that rate was 21 cents per mile.
Okay, choose one or the other.
Right. And whichever method you use for the car, you can also add on parking fees and tolls.
Good tip. Anything else?
Yes, a relatively recent addition. The cost of breast pumps and supplies that assist lactation are now considered deductible medical expenses.
That's a really comprehensive list. It definitely shows how many different costs might count towards that 7.5% threshold. But now, the flip side. Let's talk common mistakes. What medical and dental payments can you not deduct? Knowing what's out is just as important.
Absolutely. This helps avoid errors and, frankly, disappointment. So here's what you cannot include. The cost of diet food or beverages doesn't count, even if recommended by a doctor. Cosmetic surgery is generally out unless it's necessary to fix a deformity from, say, a congenital abnormality, an accident, or a disfiguring disease. But purely cosmetic procedures, no.
Okay.
Life insurance or policies that protect your income if you get sick or injured, those aren't medical expenses. And this is a big one people ask about. The Medicare tax you pay on your wages or tips, or the Medicare tax paid as part of self-employment tax or household employment tax. That's not deductible here.
Right, that's just a regular tax payment. What else is on this no-go list? Any common assumptions that are wrong?
Well, nursing care for a perfectly healthy baby. That's not deductible as a medical expense, though you might be able to take, say, the child independent care credit for it elsewhere on your return.
Different category.
Right. Illegal operations or drugs are definitely out. Also, imported drugs that aren't approved by the FDA. This includes foreign-made versions of U.S. drugs if they weren't manufactured under FDA approval. That's a trap some people fall into trying to save money on prescriptions.
Important warning.
Non-prescription medicines other than insulin are generally not deductible. So things like nicotine gum or patches, aspirin, cold medicine. No, insulin is the main exception there. Travel that your doctor told you to take just for rest or a change of scenery, even if it's for stress. Not deductible.
Even with a doctor's note.
Even with a doctor's note. And finally, funeral, burial, or cremation costs. Those are not considered medical expenses for this deduction.
That definitely clears things up and manages expectations. Okay, what about reimbursements? Like from insurance, how does that fit in? Sounds like you only count what you actually paid out of pocket.
Exactly. That's crucial for accurate reporting. You should only include the net amount you actually paid after any insurance payments. So if your insurance paid the doctor directly for part of the bill, you only count the part you paid yourself. If you paid the whole bill and then insurance reimbursed you in the same year, 2024 for 2024 expenses, you have to reduce your expense total by that reimbursement amount.
Okay, straightforward enough.
Huh.
What if the reimbursement comes later, like the next year?
That's where it gets a little trickier and often trips people up. If you receive a reimbursement in, say, 2024 for medical expenses you actually paid back in 2023,
Hmm.
you don't go back and reduce your 2024 expenses. Instead, you need to check if you actually deducted those 2023 expenses on your 2023 tax return and if that deduction actually lowered your tax for 2023.
Okay.
If both of those are true, you deducted it, and it gave you a tax benefit, then you must include that reimbursement amount as income on your 2024 return. It goes on Schedule 1, Form 1040, Line 8 says.
So it becomes taxable income in the year you get the reimbursement back.
Correct. It prevents you from getting a double benefit the deduction one year and tax-free money back the next.
Got it. And what about those employer health plans? Cafeteria plans, FSAs, HSAs? A lot of people pay premiums or have funds set aside through work.
Right. Premiums paid by an employer-sponsored health insurance plan, especially through a cafeteria plan where you elected to have the premiums taken out pre-tax, are generally not deductible.
Why not?
Because those amounts were likely never included in your taxable income in the first place. They were probably excluded from Box 1 of your W-2. So since you never paid tax on that income used for the premium, you can't turn around and deduct the premium again.
Makes sense. Another no double-dipping situation.
Exactly. Same logic often applies to funds used from flexible spending arrangements, FSAs, or health savings accounts, HSAs, if the contributions were made pre-tax. You can't deduct medical expenses paid with those already tax-advantaged funds. This is a really common point of confusion.
Wow, okay. Medical expenses definitely have a lot of very specific rules. It really shows how careful you need to be. Let's shift gears now. From our health to another area that hits almost everyone's wallet, the taxes we pay. This is where we run into that infamous state and local tax gap, the SALT cap, which has had a pretty big impact for a lot of people, hasn't it?
Oh, absolutely. The $10,000 SALT cap, it really wasn't just a small tweak. It was a major strategic shift for many taxpayers, especially if you live in a state with high income taxes or high property taxes.
Right.
The deduction for all your state and local taxes, combined income or sales tax plus property taxes, is generally limited to $10,000 per household, or just $5,000 if you're married but filing separately. For many people, particularly homeowners in those high-tax states, this cap means that even with significant property taxes, their total SALT deduction doesn't reach $10,000, or if it does, it stops there. This often pushes them towards taking the standard deduction instead of itemizing, even if they didn't before.
So even if you paid, say, $15,000 in property taxes and $8,000 in state income tax, that's $23,000 you paid.
Yeah. You can only deduct $10,000 of it on Schedule A. That's a big bite. Like you said, it fundamentally changed the math for itemizing for a lot of households.
Okay, so that's the big limit.
Yeah.
What kinds of taxes can't you deduct under this section at all? What's definitely off the table?
There's a pretty clear list of exclusions here, too. Generally, you can't deduct federal taxes.
Yeah.
So your federal income tax withheld, nope. Social Security, Medicare taxes, FICA, nope. Federal unemployment, FUTA, or railroad retirement, RRTA taxes. Also, nope.
Okay, federal stuff is out.
Right. Customs duties on imports aren't deductible here. Federal estate and gift taxes generally aren't either, although there's a very specific exception related to income in respect of a decedent, which we might touch on later under other deductions. On the state and local side, things that are more like fees for service rather than broad taxes are usually out, like state or local taxes on gasoline you use in your car, car inspection fees, assessments for local benefits that tend to increase the value of your property, think sidewalks, water mains, sewers. Those usually get added to the cost basis of your property, not deducted here.
Okay.
Taxes you paid for someone else aren't deductible by you. And various license fees, like your driver's license, marriage license, dog license, those don't count as taxes paid. Also, foreign taxes on personal property or real estate generally aren't deductible here either.
That helps narrow it down. Now, you mentioned choosing between income taxes and sales taxes earlier. That sounds like a key decision point. You can't take both.
Correct. On line 5A of Schedule A, you must make an election. You choose to deduct either your state and local income taxes or your state and local general sales taxes. You cannot deduct both for the same year.
So you literally have to figure out which one gives you a bigger deduction.
You absolutely do. For some people, the choice is obvious. Maybe they live in a state with no income tax, so sales tax is the only option. Or maybe they paid a huge amount of income tax due to a bonus or something.
Right.
But for many people, especially if they made a large purchase, like a car during the year, it requires actually running the numbers both ways to see which deduction is more advantageous. It's a classic tax planning point.
Is there anything else affecting that line 5A choice? Any weird wrinkles?
Well, there's that sort of niche safe harbor rule we touched on briefly. It relates to charitable contributions made in exchange for state or local tax credits.
Oh, right.
If you made a cash donation, got a state or local tax credit back, and because of that credit, your charitable deduction was reduced. Some or all of that disallowed charitable amount might be treatable as a payment of state or local taxes instead. If you meet the conditions and you apply the credit against your state local tax, you could potentially add that amount to line 5A, income tax, 5B, real estate tax, or 5C, personal property tax, whichever fits. It's complex, needs careful review, but could be useful in certain situations.
Interesting. Okay, let's assume someone picks the income tax route. What typically gets included there, besides the obvious state income tax withheld from paychecks?
Right, so if you don't elect the sales tax deduction, you'd start with the state and local income taxes withheld from your salary in 2024. You find that on your W-2, box 17. You might also have state or local income tax withheld shown on other forms, like a W-2G for gambling winnings, or various 1099 forms, 1099-G for unemployment, 1099-R for pensions, 1099 MISC, 1099 NEC.
Yeah.
But again, the big caution, don't include any withheld taxes here if you already deducted them somewhere else, like on a Schedule C or E for business or rental income.
Got it. What else counts as income tax paid?
You also include state and local income taxes you paid during 2024 for a prior year. For example, if you owed money when you filed your 2023 state tax return in April 2024, that payment counts for your 2024 deduction.
Ah, okay. But not penalties or interest on that late payment.
Correct, just the tax itself. Penalties and interest are not deductible. Also, any state and local estimated tax payments you made during 2024 count. And if you got a refund on your 2023 state taxes but chose to apply that refund towards your 2024 estimated taxes, that counts as a payment made in 2024.
That seems pretty comprehensive. Are there any other, maybe less common, mandatory payments that count as state income taxes?
Yes, there are. Mandatory contributions to certain state disability funds or unemployment compensation funds can be deductible as state income taxes. The instructions list specific ones, like funds in California, New Jersey, New York, Rhode Island, Washington State, Alaska, and Pennsylvania. Also, mandatory contributions to state family leave programs, like those in New Jersey and California, are included here.
Okay, so that's what you can include for income taxes. What about things you definitely can't include? Any surprises?
A couple of key things to exclude. First, don't include any state or local income tax refund or credit you expect to receive for the 2024 tax year. You only deduct what you actually paid or had withheld during 2024. Second, if you received a refund in 2024 for a prior year's state or local income taxes, like getting your 2023 refund check in 2024, you don't reduce your 2024 deduction by that amount.
So what happens with that refund then?
That refund might actually be taxable income to you in 2024. It goes back to that rule. If you deducted those state taxes in the prior year, 2023, and that deduction gave you a tax benefit, then the refund you get back in 2024 is generally considered taxable income. You'd report it on Schedule 1, line 8.
Ah, the tax benefit rule again. Okay, so now let's flip the coin. What if someone decides to deduct state and local general sales taxes instead of income taxes? How does that work? Does this mean they seriously have to save every single grocery receipt, every clothing tag, every single purchase receipt for the entire year? Because that sounds like an absolute nightmare.
That's the million-dollar question, isn't it? And thankfully, the answer is usually no, you don't have to do that. You actually have two options for figuring your sales tax deduction. Option 1 is using your actual expenses. And yes, that does require meticulous record keeping, saving receipts for all general sales taxes noted.
Okay.
Option 2, which is far more common and convenient for most people, is to use the optional sales tax tables provided by the IRS.
Okay, tell me more about option 1 first, the actual expenses route. For the brave souls who keep every receipt, what exactly counts?
Right. If you go the actual expense route, you can generally deduct the state and local general sales taxes you paid in 2024, but only if the tax rate was the same as the general sales tax rate for your area. However, there are some helpful exceptions. Sales taxes on food, clothing, medical supplies, and motor vehicles are deductible as general sales tax, even if the rate on those items was different from the general rate.
Oh, okay, so even if groceries have a lower rate or cars have a special rate.
Exactly. For food, clothing, and medical supplies, you can deduct the tax paid even if the rate was lower. For motor vehicles, you can deduct the tax paid even if the rate was different, but only up to the amount you would have paid at the general sales tax rate.
And motor vehicles is pretty broad, right?
Yes, includes cars, motorcycles, RVs, SUVs, trucks, vans, even off-road vehicles. And this also applies to any state and local general sales taxes paid for a leased motor vehicle.
Got it. Any big don'ts for the actual expense method?
The main one is don't include sales taxes paid on items used in your trade or business. Those are business expenses, deducted elsewhere, typically on Schedule C or F. And just like with income tax refunds, if you got a refund of 2024 sales taxes in 2024, you need to reduce your deduction. You got a refund in 2024 for prior year sales taxes you deducted, that refund may be taxable income this year.
Okay, so the actual expense method. Possible, but a lot of work. Those optional sales tax tables sound much more appealing for most people. How do they work? Can you give us a quick overview without making it feel like we're actually filling out the worksheet?
Definitely the more popular route. Instead of tracking every penny, you can use the 2024 optional state sales tax table and the 2024 optional local sales tax tables. They're right in the Schedule A instructions. Even easier, there's an IRS sales tax deduction calculator on their website, irs.gov. You plug in your info and it does the math for you.
Nice. So what's the logic behind the tables? How do they estimate what you paid?
The tables give you a standard amount based primarily on two things: your income and your family size. For income, it's not just your adjusted gross income, AGI. You actually start with your AGI and then add back certain common non-taxable income items. Things like tax-exempt interest, veterans benefits, workers' comp, the non-taxable portion of Social Security benefits, things like that.
Ah, so it reflects your total available spending power, not just taxable income.
Exactly. It tries to get a better picture of your household's financial situation. Then it factors in your family size, that's you, your spouse, if filing jointly, plus all your dependents claimed on the return. The idea is, based on that income level and family size, the table gives you a reasonable average amount of state sales tax you likely paid.
What happens if you didn't live in the same state all year? People move.
Good question. The worksheet and the online calculator handle that. You basically have to prorate. You figure out how many days you lived in each state, find the table amount for each state based on your income and family size, and then allocate that amount based on the number of days. So if you live 200 days in state A and 166 days in state B, you take a fraction of the state A amount and a fraction of the state B amount.
Okay, requires a bit of math, but doable. What about local sales taxes? City or county taxes, are those included in the state table amount?
Usually not. The worksheet has separate steps for adding local general sales taxes. Some states don't have widespread local sales taxes, so the instructions tell you to skip those steps. For states that do commonly have local taxes, like Alabama, Arizona, Colorado, etc., the IRS provides optional local sales tax tables to help you figure that amount, or you use your actual local general sales tax rate with the state table amount. It gets a bit fiddly if your local rate changed during the year or if you lived in different localities within the same state. Again, the online calculator is really your friend here. It handles these prorations automatically.
Yeah, that calculator sounds like the way to go. Okay, so you get your table amount for state tax, maybe add something for local tax. What about those big ticket purchases you mentioned earlier, like a car? Do those get added on top?
Yes, this is a really important part of using the tables. After you figure your general sales tax amount from the tables, state and local, the worksheet lets you add the actual sales tax you paid on certain specific large purchases.
Oh, nice. So you get the table amount PLUS, the tax on big items.
Correct. The specified items you can add tax for are motor vehicles, again, cars, trucks, RVs, motorcycles, leased vehicles. Remember the rule. If the sales tax rate on the vehicle was higher than the general rate, you can only add the amount up to the general rate. Aircraft or boats, but only if the sales tax rate you paid was the same as the general sales tax rate. And here's a very specific one: a home. That includes a mobile home or a prefabricated home, or materials for a substantial addition or major renovation to your home.
Wow, sales tax on building materials.
Yes, but again, only if the tax rate was the same as the general rate and some other conditions are met, like the state has to impose the tax directly on the sale or cost, or you bought the materials yourself and paid the tax, or your contractor was legally acting as your agent. It's quite niche, but potentially very valuable if you did a major home project.
Okay, the sales tax deduction. Definitely more involved than just checking a box, but using those tables, plus adding major purchases, seems like a really good strategy for many people. Let's move on now to line 5B. State and local real estate taxes. For homeowners, this is often a big chunk of that $10,000 SALT cap, right?
Absolutely. For homeowners, property taxes are usually one of the largest components of their state and local tax deduction. You can deduct state and local taxes paid on real estate you own as long as it's not used for business. The key requirements are that the tax must be based on the assessed value of the property, it must be charged uniformly across all similar properties in the community, and the money raised must be used for general community or governmental purposes.
What are some things people might try to include here that don't actually count as deductible real estate taxes? It seems like your property tax bill can have lots of different charges on it.
You're right, that bill can be confusing. Things you can't deduct as real estate taxes include foreign property taxes, those aren't deductible here. Charges for specific services provided to your property, like trash collection fees or water bills,
Even if they're on the tax bill.
even if they appear on the same bill. They're considered fees for service, not taxes based on value for general purposes. Also, assessments for improvements that increase your property's value, like putting in new sidewalks or sewers in the neighborhood. Those aren't deductible taxes, they're usually added to the cost basis of your home.
Okay. What about maintaining existing stuff?
Ah, good point. Charges for maintaining an existing public facility, like repairing existing sidewalks, can be deductible if they meet the other tax requirements. It's the new improvements that are usually capitalized.
Got it. Many people have their property taxes paid through their mortgage escrow account. How does that work for the deduction?
If your mortgage lender pays your real estate taxes from an escrow account, you can only deduct the amount the lender actually paid out to the taxing authority during 2024. It's not based on what you paid into the escrow account during the year, but what actually went out to pay the tax bill. Your lender usually reports this amount on your year-end mortgage statement. Form 1098 might show it too.
Okay, based on actual payment date by the lender, what if you sell your home during the year?
When you sell, the real estate taxes are typically prorated between the buyer and seller based on the closing date. Any tax that was technically the buyer's responsibility, but you might have prepaid and then got reimbursed for at closing, effectively acts as a refund to you and reduces your deductible amount.
And prepayments. Can you pay your 2025 property taxes in December 2024 and deduct them in 2024?
Generally, no. For real estate taxes to be deductible in 2024, they must have been paid in 2024, and the tax must have been assessed before 2025. You can't just prepay future year taxes to accelerate the deduction unless the assessment for that future period already happened before year end.
Okay. And refunds follow the same pattern as other taxes.
Yep. If you get a refund in 2024 for 2024 taxes, reduce your deduction. If you get a refund in 2024 for prior year taxes you deducted and got a benefit from, that refund is likely taxable income in 2024.
Okay, so that covers real estate taxes.
Yeah.
What about line 5C, state and local personal property taxes? What falls under that? Is that mainly cars?
Primarily, yes. Think cars, boats, maybe RVs in some states. The key rule here is that the tax must be based only on the value of the personal property, and it must be imposed on an annual basis.
So if your car registration fee is like partly based on value and partly a flat fee or based on weight.
Then you can only deduct the portion that is explicitly based on the car's value. You'd need your state's DMV or tax authority information to figure out that allocation. The flat fee or weight-based part isn't deductible here.
And the prepayment rule is the same as for real estate taxes.
Exactly the same. Deductible in 2024 only if paid in 2024 and assessed prior to 2025.
Got it. Is there any other kind of tax that fits into the SALT category,
Yeah.
like another taxes line?
There is an other taxes line, line 6, but it's very limited and doesn't usually interact with the $10,000 SALT cap in the same way. The main things that might go here are foreign income taxes. But most people who pay foreign income taxes are better off taking a foreign tax credit instead of a deduction, which is done elsewhere on the return. It's usually more valuable.
Okay.
The other item mentioned for line 6 is the generation skipping transfer GST tax imposed on certain income distributions. That's a pretty specialized situation. Importantly, don't put taxes paid to U.S. territories here. Those should go on the appropriate state-local lines, 5A, 5B, 5C. And don't put federal estate tax on income in respect of decedent here. That has its own spot later on line 16.
All right, that wraps up the complex world of taxes you paid, capped by that $10,000 limit. Now let's pivot to another major deduction category for many, interest you paid, particularly interest related to your home. What are the general ground rules here? I know you can't just deduct interest on your credit cards or personal loans anymore.
That's the absolute starting point. The deductibility of interest really hinges on how you use the loan proceeds. Was it for business? Personal use? Investment? As you said, personal interest like on credit cards, car loans. Unless the car is used for business, personal lines of credit is generally not deductible. Gone. Wiped out by tax reform a while back.
Right.
The major exceptions we still have are qualified home mortgage interest, which we'll dig into now on Schedule A, and interest on qualified student loans, which actually gets deducted separately on Schedule 1 of Form 1040, not here.
Okay. And if a loan was used for multiple things, like a home equity loan used partly for home improvements and partly to pay off other debt.
You have to allocate. The IRS has specific tracing rules. You need to trace where the loan money actually went and allocate the interest expense accordingly. Only the portion allocable to deductible purposes, like qualifying home improvements, would potentially be deductible. Also, you can generally only deduct interest that applies to the current year, 2024. Even if you paid extra interest in 2024 that covers a period in 2025, you usually can't deduct that future interest until 2025.
Okay, so personal interest out, home mortgage interest potentially in, but with some really important rules and limits. This is where things have changed significantly and can get confusing fast, right? The rules around home equity debt and loan limits.
Absolutely critical to understand this part. First, let's define home mortgage. It's broader than just your main house. It's any loan secured by your main home or a second home.
A second home, too.
Okay. Yes. And that home could be a house, a condo, a co-op apartment, a mobile home, even a boat or an RV, as long as it has basic living accommodations, sleeping space, a toilet, cooking facilities. If the loan is secured by that qualifying property, it's potentially home mortgage debt.
Doesn't matter what the bank calls the loan, like first mortgage, second, HELOC.
Doesn't matter what they call it. If it's secured by the qualified home, it falls under these rules. Now, the key limits. And this is where people really get tripped up post-tax reform. Limit number 1, use of proceeds. Interest is only deductible if the loan money was used to buy, build, or substantially improve the home that secures the loan. This is what the IRS calls home acquisition debt or qualifying debt.
So if you take out a home equity line of credit, a HELOC, secured by your house, but you use the money to pay off credit cards or buy a car or take a vacation.
That interest is generally not deductible anymore. Even though the loan is secured by your home, the proceeds weren't used to buy, build, or improve that home. This is a massive change from the old rules where home equity interest was often deductible regardless of use.
Huge. So you have to check a box on line 8 if not all the loan proceeds were used for those qualifying purposes.
Correct. There's a specific box to check if that's the case. The only real exception is for mortgages taken out way back on or before October 13, 1987. Those are grandfathered in.
Okay, use of proceeds is restriction number 1. What's number 2? The dollar limits on the loans.
Right. Restriction number 2 is the amount of debt on which you can deduct interest. And this depends on when you took out the mortgage. For qualifying home acquisition debt taken out on or before December 15, 2017, you can generally deduct interest on up to $1 million of that debt. $500,000 if married filing separately.
Okay, that's the older, higher limit.
Yes. But for qualifying home acquisition debt taken out after December 15th, 2017, the limit is lower, $750,000, $375,000 if married filing separately.
Okay, so newer loans have a lower cap. What if you have both, like an older mortgage and a newer HELOC used for improvements?
Good question. If you have debt subject to both limits, the total amount of qualifying debt across both loans generally cannot exceed $750,000 for interest deduction purposes. The $750 K limit is effectively reduced by the amount of your older pre-December 16, 2017 debt. It gets complicated, and Publication 936 has worksheets for this.
Okay, so a $1,500 limit for older debt, $750K, $375K for newer debt, and a combined interaction. Wow. Any exceptions there?
There was a very brief window. If you entered into a written binding contract before December 15th, 2017, to close on the purchase of a principal residence before January 1st, 2018, and actually close before April 1st, 2018, that debt might be treated under the older $1 million limit. Very specific time frame.
Okay, so be aware of when you took out your loan. That's critical. What happens if your total mortgage balance is actually more than your home is worth, like being underwater?
That adds another layer of complexity. If the total amount of all mortgages secured by the home exceeds the home's fair market value, special rules apply. Again, you'd need to consult Publication 936 to figure out the deductible portion of the interest. The deduction can be limited in that scenario.
Makes sense.
Yeah.
Okay, so that's the theory and the limits. How do you actually report this on Schedule A? Where does the number come from?
Most people get a Form 1098 mortgage interest statement from their lender. Box 1 of that form usually shows the mortgage interest you paid during the year. You generally enter the amount from Form 1098, Box 1 on line 8A of Schedule A. Unless one of those limits we just discussed applies to you, either the use of proceeds limit or the dollar amount limit, or $750K. If a limit does apply, you can't just put the full amount from Box 1. You have to use the worksheets in Publication 936 to calculate the deductible amount of interest and enter that calculated amount on line 8A instead.
Ah, okay. So Form 1098 is the starting point, but not always the final answer if limits apply. What if Form 1098 shows a refund of interest you overpaid?
If Box 4 of your 1098 shows a refund of overpaid interest, you generally don't reduce your deduction on line 8A by that amount. Instead, that refund might be taxable income to you, reported on Schedule 1, line 8 some.
Okay. What if you share a mortgage with someone else, like a sibling or an unmarried partner, and the 1098 only have one person's name and SSN on it?
Great question. If you're legally liable for the mortgage and actually made payments, you can deduct your share of the interest, even if your name isn't on the 1098. If the 1098 went to the other person, you'd report your share of the deductible interest on line 8B instead of 8A. You should attach a statement explaining the situation and showing the name and address of the person who received the Form 1098.
Okay, line 8B is for interest not reported on a 1098 to you. What else goes on 8B? What if you didn't get a 1098 at all? Maybe you have a private mortgage with the person you bought the house from.
Exactly. Line 8B is also used if you paid deductible home mortgage interest, but the recipient wasn't required to send you a Form 1098. A common example is a seller-financed mortgage. If you paid interest on a seller-financed mortgage, you report the deductible amount on line 8B, and this is crucial. You must also write the seller's name, their identifying number, usually their social security number, and their address on the dotted lines next to line 8B.
You have to provide the seller's info.
Yes, and you're also required to let the seller know your SSN. The IRS wants to be able to match the deduction you're claiming with the interest income the seller should be reporting. Failure to provide the seller's info can result in a $50 penalty. So definitely get that information if you're in that situation.
Good warning about the penalty.
Yeah.
Okay, let's talk about points line 8C. People often pay points when they get a mortgage or refinance. Are those deductible? How does that work?
Points, sometimes called loan origination fees or discount points, can be deductible, but the rules are specific. Generally, points are considered prepaid interest. You can deduct points in the year you paid them only if the loan was used to buy or build your main home, and if paying points is an established practice in your area and the points weren't excessive. Points paid only to borrow money generally qualify. Points paid for specific lender services, like appraisal fees or document prep fees, are not deductible as interest.
Okay, deductible in year paid for buying or building a main home. What about points paid for refinancing or on a second home?
For refinancing, the rules are different. Generally, points paid on a refinance must be deducted over the life of the new loan. You can't deduct them all up front.
Spread them out.
Right. You deduct a portion each year. However, there's an exception. If part of the refinance proceeds were used to substantially improve your main home, the portion of the points related to those improvements may be deductible in the year paid. The rest would still be deducted over the loan term. Points paid on a loan for a second home also generally have to be deducted over the life of the loan.
Okay. What if you pay off the mortgage early, like you sell the house or refinance again? Do you lose the rest of the points deduction?
No, thankfully. If you pay off a mortgage early on, which you were deducting points over time, you can generally deduct any remaining undeducted points in the year you pay off the loan.
Ah, you get to catch up.
Exactly. There's a small exception if you refinance with the same lender. In that case, you might have to continue deducting the points over the term of the new loan. Pub 936 has the details there too.
All right, that covers home mortgage interest and points pretty thoroughly. What about line 9, investment interest? Does that apply to many people?
It applies if you borrow money specifically to make investments. Line 9 is for deducting investment interest expense. This is interest paid on money borrowed that is allocable to property held for investment.
Like borrowing on margin to buy stocks.
Exactly like that. Or taking out a loan where the proceeds are directly traceable to purchasing bonds or other investment property. It does not include interest related to passive activities, like most rental real estate that usually goes on Schedule E, or interest on loans used to buy securities that generate tax-exempt income, like municipal bonds. You can't deduct interest used to earn tax-free income.
Makes sense. Is there a special form for this? It sounds like it could have limits.
Yes, generally you need to complete and attach Form 4952 Investment Interest Expense Deduction. Your deduction for investment interest is typically limited to your net investment income for the year. Net investment income includes things like taxable interest, ordinary dividends, and certain capital gains, minus some investment expenses. Any interest you can't deduct due to this limit can usually be carried forward to future years.
Do you always have to file Form 4952 if you have investment interest? Or are there simpler cases? Filing extra forms is never fun.
There is an exception. You don't have to file Form 4952 if all three of these conditions are met. 1, your investment interest expense is less than your investment income from taxable interest and ordinary dividends, after subtracting any qualified dividends taxed at lower rates. 2, you have no other deductible investment expenses besides interest. And 3, you have no disallowed investment interest expense being carried forward from the prior year, 2023. If all that's true, you can deduct the full investment interest directly on Schedule A, line 9, without the form.
Okay, good to know there's a simpler path sometimes. Any other quirks with investment interest?
Just one specific note mentioned in the instructions. Alaska Permanent Fund dividends, which residents of Alaska receive, are not considered investment income for the purpose of calculating this deduction limit. That's a niche point, but important for Alaskans.
All right, we've tackled medical, taxes, and interest. Let's shift now to an area driven by generosity but still needing strategy. Gifts to charity, lines 11 through 14. Giving back is great, but making sure that kindness also translates into a tax deduction requires following the rules. How can people give smart and deduct wisely here?
The absolute first step is fundamental. Make sure you're donating to a qualified charitable organization. Not every nonprofit counts for a tax deduction.
What makes an organization qualified?
Generally, these are religious, charitable, educational, scientific, or literary organizations, or groups organized to prevent cruelty to children or animals. Think churches, synagogues, mosques. Groups like the Scouts, Red Cross, Salvation Army. Most nonprofit hospitals and colleges, although payments to colleges are not deductible if they're essentially tuition or give you the right to buy athletic tickets, federal, state, and local governments also count, but only if your gift is made solely for public purposes.
Is there an easy way to check if a specific charity is qualified?
Yes, definitely. The IRS has an online search tool called the Tax-Exempt Organization Search, or TEOS. You can find it easily on irs.gov/TEOS. You can look up an organization and verify if contributions to it are tax deductible. It's a really useful tool to use before you donate if you're unsure.
Great tip. Okay, so you found a qualified charity. What kinds of contributions can you actually deduct? Is it only cash?
No, it's much broader than just cash. You can deduct contributions of cash, obviously, but also contributions of property, things like stocks, clothing, furniture, even cars. And you can also deduct certain out-of-pocket expenses you incur while doing volunteer work for a qualified charity.
Like what kind of expenses?
The main one is travel. If you use your car to, say, deliver meals for a charity or drive to volunteer meetings, you can deduct your actual cost of gas and oil for those trips. Or, similar to medical travel, you can use a standard mileage rate. For charitable miles driven in 2024, the rate was 14 cents per mile.
Lower than the medical rate.
Yes, significantly lower. And whichever method you use for the car, you can also add the cost of parking fees and tolls related to that volunteer travel. Just remember, you can't deduct any expenses that the charity reimbursed you for.
Okay. What if you make a donation, but you get something back in return? Like attending a charity dinner or getting a tote bag for your contribution?
That's a really common scenario. The general rule is, if you make a gift and receive a benefit in return, like food, merchandise, entertainment, You can only deduct the amount of your contribution that is more than the value of the benefit you received.
So only the true gift portion.
Exactly. For example, if you pay $100 for a ticket to a charity dinner and the charity tells you the fair market value of the dinner itself is $40, you can only deduct $60, a $100 payment, $40 benefit. There are some exceptions for like small low-cost benefits or token items or certain membership benefits, like if you pay $75 or less for an annual membership and the benefits are minor. In those cases, you might be able to deduct the full amount. The charity should usually tell you the value of what you received.
Makes sense. What about the record keeping, especially for larger gifts? Are there special rules if you donate, say, $250 or more at one time?
Yes, absolutely. This is a huge compliance point the IRS checks. For any single contribution, whether cash or property of $250 or more, you must have a specific type of receipt. It's called a contemporaneous written acknowledgement from the charity.
Contemporaneous written acknowledgement. Okay. What does that need to include?
It needs to have several key pieces of information. One, the amount of cash contributed and/or a description, but not the value of any property donated. Two, a statement saying whether the charity provided any goods or services in return for the contribution. Three, if they did provide goods or services, it needs a description and a good faith estimate of their value. Four, if the only benefit received was an intangible religious benefit, like admission to a religious service, the acknowledgement must state that, but doesn't have to describe or value it.
And contemporaneous means you need to get this before you file your tax return.
Yes. You must receive this written acknowledgement from the charity by the date you file your return for that year, including any extensions. You don't attach it to your return, but you absolutely must keep it with your tax records. Without it, the IRS can disallow the deduction if you're audited.
Okay. What if you make lots of smaller donations to the same charity, like weekly church offerings? Do you need this acknowledgement if the total adds up to over $250?
Good question. No. When figuring if a gift is $250 or more, you don't combine separate donations made at different times. So if you give your church $50 every week, even though the total for the year is way over $250, each $50 payment is treated as a separate gift. You don't need that specific $250 plus acknowledgement for those individual smaller gifts, though you still need basic records like canceled checks or statements. Same logic applies to payroll deductions. Each deduction from each paycheck is separate.
That's a very helpful clarification. Are there overall limits on how much you can deduct for charity each year based on your income? You mentioned AGI limits earlier.
Yes, there are limits, and they can get a bit complicated because they depend on your AGI and the type of contribution, cash versus property, and sometimes the type of charity. As a general rule of thumb, for cash contributions to most public charities, your deduction is limited to 60% of your adjusted gross income. AGI from Form 1040, line 11.
60%. That's pretty high.
It is. For contributions of property that's considered ordinary income property, like inventory, the limit is often lower, maybe 50% or 30% of AGI. For contributions of capital gain property, like stocks held long-term, the limit is often 30% of AGI, or sometimes even 20%, depending on the type of charity.
Okay, so different limits for different types of gifts. This sounds like something people might need professional advice on if they make large or complex donations.
It can definitely get complex, especially with property donations or contributions to private foundations. The instructions have details, but advice might be needed. If your total contributions exceed these AGI limits in a given year, you generally can carry over the excess amount to deduct in future years, usually for up to 5 years.
The carryover applies here too. Good to know. Okay, now let's cover the don'ts again. What are some common things people think are charitable donations but actually aren't deductible? Let's avoid those mistakes.
Right, this is crucial. Here's a list of common non-deductible items. Contributions where you get a state or local tax credit back, unless it falls under that narrow safe harbor we talked about under the SALT deduction. Generally, if you get a quid pro quo credit, it's not a deductible charitable gift. Payments made to colleges or universities specifically for the right to buy tickets to athletic events. That's considered buying access, not a pure donation.
Sure.
Travel expenses, including meals and lodging, while you're away performing donated services, if there's a significant element of personal pleasure, recreation, or vacation involved in the trip. The primary purpose has to be the volunteer work.
Right. No disguised vacations?
Exactly. Contributions to political candidates, campaigns, or parties, not deductible as charity. Dues, fees, or bills paid to groups like country clubs, lodges, fraternal orders, unless they are specifically earmarked and used for genuine charitable purposes by that organization. Regular membership dues usually aren't. The cost of raffle tickets, bingo games, or lottery tickets bought from a charity, that's considered gambling, not a donation. Though, as we'll see, gambling losses might be deductible elsewhere up to your winnings.
Yeah, well,
The value of your time or your professional services, you can't deduct $6 per hour for the time you volunteered, only your out-of-pocket costs. The value of blood donated to a blood bank, not deductible. A contribution of a future interest in tangible personal property. Like saying, you'll donate the painting in 5 years, but keep it now. Usually not deductible until the charity actually possesses it. Gifts made directly to individuals, no matter how needy they are, it has to be to a qualified organization. Gifts to groups run for private profit. Gifts to most foreign organizations, with very limited exceptions for certain charities in Canada, Mexico, Israel, and some others via U.S. Friends of Organizations. Gifts to groups engaged in lobbying or political activities that directly benefit your business financially. Gifts to lobbying groups in general.
lots of political exclusion.
Yes. Gifts to civic leagues, social clubs, sports clubs, labor unions, chambers of commerce, generally not qualified charities. The value of any benefit you received in connection with your contribution, unless one of those exceptions for minor benefits applies. And finally, the cost of tuition paid to a school, even a nonprofit one. That's paying for educational services, not a donation, though education credits might apply separately.
That is a very thorough list of what not to deduct. It really highlights the need to donate to established qualified organizations and understand the quid pro quo rules.
Okay, let's circle back to record keeping for different types of gifts. You mentioned the $250 acknowledgement. What about smaller cash gifts or non-cash gifts under $250?
Good question. For any cash contribution, regardless of the amount, you need some kind of record. It has to be either a bank record, like a canceled check, a bank statement showing the transfer, or a credit card statement, or a written record from the charity, like a receipt or letter, showing the charity's name, the date, and the amount. You need one or the other. A pledge card alone isn't enough.
So even for putting $5 in the collection plate, you technically need proof.
Technically, yes, although the practical enforcement on very small amounts might vary, but the rule requires a record. For the $250 plus gifts, remember you need both the basic cash record and that specific contemporaneous written acknowledgement.
Got it. What about donating property other than cash, like bags of clothes, furniture, maybe stocks? For non-cash contributions, the general rule is you deduct the fair market value, FMV, of the property at the time you donated it. FMV is basically what a willing buyer would pay a willing seller.
How do you figure out the FMV, especially for used items like clothes or furniture?
That can be tricky. IRS Publication 561, Determining the Value of Donated Property, gives guidance. For used clothing and household items, thrift store values are often a reasonable guide, but the items generally must be in good used condition or better to be deductible at all.
Good used condition or better. Okay.
If your total deduction for all non-cash contributions for the year is more than $500, you have to take an extra step. You must complete and attach Form 8283 non-cash charitable contributions to your tax return.
Form 8283 for over $500 in total non-cash gifts.
Correct. That $500 threshold applies to the total value you're claiming before considering any AGI limits.
Are there even more rules for specific types of property, like cars?
Yes. Cars, boats, and airplanes have special rules if the claim deduction is more than $500. Generally, your deduction is limited to the gross proceeds the charity receives when they sell the vehicle. The charity is required to provide you with a specific form, usually Form 1098-C, reporting this information, and you must attach a copy of that form to your return. There are exceptions allowing you to claim FMV if the charity uses the vehicle significantly or makes major improvements, but the default is the sale price.
Okay, car donations are complicated. What about that good used condition rule for clothing and household items? Any exceptions?
Yes, there's one exception. If you donate a single item of clothing or a household item that's not in good use condition or better, but you claim a deduction for it of more than $500, you can still deduct it if you get a qualified appraisal for that specific item and attach the appraisal along with Form 8283 to your return. But that's a high bar for, say, damaged furniture.
Right. So besides Form 8283, what records do you need for property donations in general?
For all property donations, you need reliable written records showing the name and address of the charity, the date and location of the contribution, a reasonably detailed description of the property, its fair market value at the time of donation and how you figure that value, and the property's original cost or basis, how much you paid for it, plus improvements, minus depreciation if applicable. You also need records about any conditions attached to the gift. And again, if the property donation is valued at $250 or more, you also need that contemporaneous written acknowledgement from the charity. Form 8283 does not replace the need for that acknowledgement.
Wow. Lots of paperwork potential, especially for property. What about those carryovers you mentioned? Line 13. If you hit the AGI limits, how does that work again?
Right. Line 13 is where you'd report contributions carried over from prior years. If you made contributions in a previous year, generally within the last 5 years, that you couldn't fully deduct because they exceeded your AGI limit for that year, you can carry the unused amount forward. You deduct these carryover amounts in the current year, subject to the same AGI limits, generally after you deduct any current year contributions of the same type. There's a specific ordering rule.
Okay. Any special rules for carryovers right now?
There was a note about carryovers from 2020 or 2021 contributions potentially being subject to a 60% AGI limit in 2024, which is a bit higher than some standard limits. It's just something to be aware of if you have carryovers from those specific years due to special pandemic-era rules. It allows for longer-term planning to maximize your deductions.
All right. That covers charity quite well. Let's move to the next section, line 15, casualty and theft losses. This one's become very narrow, hasn't it? It's not like it used to be.
Extremely narrow for personal losses now. For individuals, you can only deduct casualty and theft losses of personal use property, like your home, car, furniture, if the loss is attributable to a federally declared disaster.
Federally declared disaster. So a regular house fire, a tree falling on your car in a storm, a burglary. If it wasn't part of an event the president declared a major disaster for your specific area, you get no deduction for that personal loss.
That's correct for personal use property. It's a huge change from the old rules. The disaster has to be officially declared, and your loss has to have occurred in that declared disaster area. You have to use Form 4684, casualties and thefts, to figure out any potential loss.
Okay, so it has to be a declared disaster. And even then, there are still thresholds, right? It's not dollar for dollar.
Right. Even if you do have a qualifying loss from a federally declared disaster, there are two hurdles it still needs to clear. First, you have to reduce the amount of each separate casualty or theft event by $100. Second, after applying the $100 reduction per event, you then have to subtract 10% of your adjusted gross income, AGI from Form 1040, line 11, from your total net casualty losses for the year. Only the amount that exceeds 10% of your AGI is actually deductible on Schedule A, line 15.
Wow. So $100 off each event, then 10% of AGI off the total. That wipes out the deduction for all but the most severe losses, even within a disaster area.
It really does. It's designed to cover truly significant, uncompensated losses relative to your income.
Is there anything else about reporting these? Something about line 16?
Yes, there's a specific interaction with line 16. If, after filling out Form 4684, you have something called a net qualified disaster loss, which comes from line 15 of Form 4684, you don't put that amount on Schedule A, line 15. Instead, that specific type of loss goes on Schedule A, line 16, under other itemized deductions. This is important because reporting it there allows it to potentially increase your standard deduction if you end up not itemizing, or it gets included with other miscellaneous deductions if you do itemize. It has a special treatment.
Okay, very specific rules there. Definitely something for people affected by major disasters to look into carefully. Finally, let's look at that catch-all sounding category. Line 16, other itemized deductions. What actually fits here? It sounds like a miscellaneous bucket, but I suspect it's not that simple.
You suspect correctly. It is absolutely not a miscellaneous free-for-all. Most of the old miscellaneous itemized deductions that used to be subject to a 2% AGI floor, like unreimbursed employee expenses, tax prep fees, investment expenses, were eliminated by tax reform. Line 16 is now reserved for only a very specific, limited list of deductions. The instructions refer you to Publication 529, Miscellaneous Deductions for the official list, but we can hit the main ones.
Okay, so what makes this very exclusive list? What are some practical examples for listeners?
Probably the most common one that might apply is gambling losses.
Ah, okay, so if you lost money gambling?
Yes, but with a huge caveat. You can only deduct gambling losses up to the amount of your gambling winnings that you reported as income elsewhere on your return, specifically on Schedule 1, Form 1040, Line 8B. So if you won $1,000 at the casino but lost $1,500 over the year, you can report the $1,000 winnings as income and then deduct $1,000 of your losses here on Line 16. Your net effect is zero tax on the gambling activity. You can't deduct the extra $500 loss to offset other income.
So it just cancels out winnings, doesn't create a loss.
Yeah.
Does this include things like lottery tickets?
Yes. The definition of gambling losses here includes the cost of non-winning bingo, lottery, and raffle tickets. So keep track of those losing tickets if you also have winnings to report.
Good tip. What else is on the line 16 list?
Okay, a few others. Casualty and theft losses, but specifically of income-producing property. This is different from the personal losses we just discussed. These might come from Form 4684 or Form 4797 and could apply if, say, your rental property, which produces income, suffered damage in a storm that wasn't a federally declared disaster.
Okay, different rule for income property.
Right. Then there's the federal estate tax paid on income in respect of a decedent, IRD. This is pretty specialized. If someone inherits income that the deceased person had earned but hadn't received before death, like a final paycheck or IRA distributions, and if that income was also subject to federal estate tax in the deceased person's estate, the beneficiary who pays income tax on the IRD might get an income tax deduction here for the portion of the estate tax attributable to that income.
Very specific. What else?
A deduction for amortizable bond premium. If you buy a taxable bond for more than its face value, you might be able to elect to deduct a portion of that premium each year over the bond's life. That deduction goes here. An ordinary loss related to certain complex debt instruments, like contingent payment debt or inflation-indexed bonds, like TIPS. A deduction for repayment of amounts under a claim of right. This applies if you had to repay more than $3,000 in a single year that you had included in your income in a prior year because you thought you had a right to it then, but later found out you didn't. Think maybe having to repay erroneously calculated bonus money.
Ah, okay.
Certain unrecovered investment in a pension or annuity if payments cease before you recover your cost. And finally, impairment-related work expenses for individuals with disabilities. These are expenses necessary for the person to be able to work, like attendant care services at the workplace.
These are clearly very specific situations, mostly relevant to a smaller group of taxpayers, but crucial not to overlook them if they do apply to your unique circumstances, as they can still offer real savings. Okay, so we've gone through all the potential itemized deductions: medical, SALT taxes, interest, charity, casualty theft, and these other specific ones. After calculating everything meticulously, what's the final step in this journey?
The final step is simple arithmetic, but strategically important. You add up all your calculated itemized deductions from lines 4, 7, 10, 14, 15, and 16. That total goes on line 17. Then you compare that total on line 17 to your standard deduction amount for your filing status, which you find on your Form 1040.
And the big decision, you take whichever number is higher, right, to get the biggest reduction in your taxable income. That's where all this detail pays off.
Exactly. In almost all cases, you'll claim the larger of the two. If your itemized deductions on line 17 add up to more than your standard deduction, you enter that itemized total on line 18 and also on your Form 1040 line 12, you're itemizing. If your standard deduction is higher than your total itemized deductions, you'll generally just take the standard deduction instead by entering that amount on Form 1040 line 12.
Is there ever a reason to itemize even if your standard deduction is higher?
There is, actually. It's uncommon for federal purposes, but possible. Some state tax systems might require you to itemize on your federal return to be able to itemize on your state return. And sometimes itemizing on the state return might save you more state tax than you'd lose federally by not taking the higher federal standard deduction.
State tax implications.
Right. So if you choose to itemize, even though your standard deduction is higher, perhaps for state tax reasons, you check a specific box on Schedule A, line 18, indicating you're making that election. But for most people, it's simply about taking the bigger number for federal purposes.
Okay. Well, we have certainly navigated the intricate world of Schedule A today. We've uncovered a whole range of potential deductions, medical costs, all those different taxes, home interest intricacies, charitable giving rules, and those very specific other losses. This deep dive really did cut through a lot of complexity.
It really shows, I think, that managing your taxes isn't just about filling out forms by the deadline. It's about being informed, being proactive. These rules, yeah, they're complex, undeniably, but understanding them offers pathways to potentially keep more of what you earn. It shifts the mindset from just compliance to, strategic optimization.
So, as you, our listeners, look ahead to your own financial picture, maybe consider this. How might a deeper understanding of these seemingly small details, the thresholds, the limits, the definitions, how might that transform your overall tax strategy? Not just for this year, but for the years to come. The knowledge, or at least a solid overview of it, is now yours. What will you do with it? Thank you so much for joining us on this detailed deep dive into itemized deductions on Schedule A. We really hope this has armed you with some valuable insights for navigating your 2024 tax season and planning ahead.
Absolutely. And if this conversation sparked more questions, or maybe you have other tax forms or financial sources you'd like us to unpack in a future deep dive, please let us know. We enjoy helping you become well informed one source at a time.